Warren Buffett is a name synonymous with investing wisdom. The Oracle of Omaha has built Berkshire Hathaway into a colossal empire, making him one of the richest people on the planet. His approach to investing is admired by millions and studied by professionals worldwide. But one question has perplexed investors for years: why does Warren Buffett refuse to invest in Tesla? On one side, we have Tesla, an innovative, game-changing company that has disrupted the automobile industry. On the other, we have Warren Buffett, a traditionalist who believes in stable, predictable, and time-tested businesses. While Tesla has skyrocketed in value and made its CEO Elon Musk the richest man in the world, at times Buffett has stayed away. To understand this decision, we must first understand Warren Buffett's core investing principles. Buffett follows a philosophy called value investing, pioneered by his mentor Benjamin Graham. This strategy focuses on buying businesses that are undervalued by the market but have strong fundamentals, solid cash flow, reliable earnings, and a durable competitive advantage. Buffett's investment decisions are guided by several key principles. Invest in what you understand. Buffett believes in investing in companies that have a clear and predictable future. He prefers businesses with simple business models like Coca-Cola, Apple, and American Express. These companies have been around for decades and have proven their ability to generate profits consistently. Economic moats matter. Buffett loves companies with strong competitive advantages or moats. A moat is what protects a business from competition, whether it's brand loyalty, cost advantages, or network effects. Companies like Visa and See's Candies, which Buffett owns, have deep-rooted customer loyalty. Strong cash flow and profits. A company must generate consistent cash flow and earnings. Buffett avoids companies with unpredictable or erratic financials. Avoid speculation. Buffett doesn't believe in buying stocks based on hype, momentum, or speculative future growth. He prefers proven winners over uncertain bets. Management matters. Buffett values great leadership. He invests in companies where management is ethical, competent, and shareholder-friendly. Now, let's compare these principles to Tesla and see why Buffett remains skeptical. Tesla is undoubtedly a revolutionary company. It has reshaped the auto industry and made electric vehicles mainstream. But when we analyze Tesla from Buffett's perspective, several red flags appear. In the next part, we will explore how Tesla's business model and financials conflict with Buffett's investing philosophy. Tesla is one of the most exciting companies of the 21st century. It has pioneered electric vehicles, disrupted the auto industry, and made Elon Musk a household name. Its stock has experienced massive growth, making early investors incredibly wealthy. However, when we analyze Tesla through Warren Buffett's lens, several conflicts arise between Buffett's investment philosophy and Tesla's business model. Buffett is known for investing in businesses with predictable earnings and stable cash flow. Companies like Apple, Coca-Cola, and American Express generate consistent profits year after year. Tesla, on the other hand, has been a roller coaster. For years, it struggled to turn a profit. Even after becoming profitable, its earnings remain volatile. In contrast, Buffett prefers companies that produce steady, reliable profits with minimal fluctuations. Tesla's financial history includes years of burning cash with heavy investments in factories, R&D, and expansion. Inconsistent profitability until 2020, nearly 2 decades after its founding. Revenue that fluctuates based on vehicle production, supply chain challenges, and competition. Legacy automakers, Ford, GM, Volkswagen, and Toyota, are aggressively entering the EV space. Chinese manufacturers like BYD and NIO are becoming major competitors. Battery technology and autonomous driving remain highly competitive, with companies like Rivian and Lucid emerging as rivals. Buffett has often said that just because a company is a pioneer doesn't mean it will dominate forever. He prefers businesses with durable moats that withstand decades of competition, like Apple's ecosystem or Coca-Cola's brand loyalty. Tesla's moat isn't as deep or long-lasting as Buffett would like. Buffett also emphasizes the importance of strong, predictable management. He prefers CEOs who are disciplined, focused, and avoid unnecessary risks. Elon Musk, while undeniably brilliant, is the opposite of what Buffett looks for in a CEO. Musk is unpredictable, outspoken, and often engages in risky ventures. He manages multiple companies simultaneously: Tesla, SpaceX, The Boring Company, and X, formerly Twitter. His leadership style is bold and aggressive, which makes Tesla an exciting company, but also an unpredictable investment. Buffett has often said that he prefers companies with earnings that he can predict 10 years into the future. With Tesla, that level of certainty simply doesn't exist. Point 1 of Buffett's key investing rules is to never overpay for a stock. He believes in buying companies when they are undervalued. Tesla, however, has frequently traded at sky-high valuations. At one point, its market capitalization exceeded that of several legacy automakers combined, despite selling far fewer vehicles. Buffett, being a value investor, would find it difficult to justify paying such a high price for a company that still faces significant risks. Buffett loves businesses with strong and lasting competitive advantages, or what he calls economic moats. A moat is what keeps competitors from stealing market share. Tesla had a strong first-mover advantage in electric vehicles, but over time, that advantage has weakened. Legacy automakers Ford, GM, Volkswagen, and Toyota are aggressively entering the EV space. Chinese manufacturers like BYD and NIO are becoming major competitors. Battery technology and autonomous driving remain highly competitive, with companies like Rivian and Lucid emerging as rivals. Buffett has often said that just because a company is a pioneer doesn't mean it will dominate forever. He prefers businesses with durable moats that withstand decades of competition, like Apple's ecosystem or Coca-Cola's brand loyalty. Tesla's moat isn't as deep or long-lasting as Buffett would like. Buffett also emphasizes the importance of strong, predictable management. He prefers CEOs who are disciplined, focused, and avoid unnecessary risks. Elon Musk, while undeniably brilliant, is the opposite of what Buffett looks for in a CEO. Musk is unpredictable, outspoken, and often engages in risky ventures. He manages multiple companies simultaneously: Tesla, SpaceX, The Boring Company, and X, formerly Twitter. His leadership style is bold and aggressive, which makes Tesla an exciting company but also an unpredictable investment. Buffett prefers CEOs like Tim Cook of Apple or Ajay Banga of MasterCard, leaders who are consistent, shareholder-friendly, and not prone to controversy. Here's an interesting fact: while Buffett has avoided Tesla, he has invested in a different electric vehicle company, BYD. In 2008, Berkshire Hathaway bought a stake in the Chinese automaker BYD, which has since become one of Tesla's biggest global competitors. Why? Because BYD fits Buffett's investment criteria better than Tesla. More predictable financials: BYD has strong sales in China and a diversified business beyond just EVs. Better valuation at the time of investment: Buffett bought into BYD when it was still undervalued. Stable management: BYD's leadership is less controversial than Elon Musk. This shows that Buffett isn't against investing in electric vehicles, he just prefers a company that aligns with his principles. In the next part, we'll discuss another crucial reason Buffett avoids Tesla: the risks and uncertainties of the auto industry itself. While Tesla's high valuation, unpredictable leadership, and competitive risks are major reasons Buffett avoids investing, there's an even bigger factor at play. Buffett doesn't like the auto industry as an investment. This may come as a surprise. After all, Tesla has revolutionized the automotive sector with electric vehicles, autonomous driving, and energy storage solutions. But to Buffett, history has shown that the auto industry is a tough business, full of risk, heavy capital investment, and intense competition. Buffett has often pointed to history when explaining why he avoids automakers. In a famous speech, he remarked, "The auto industry has been a terrible place to invest over the last century." And he's right. The U.S. auto industry has seen countless companies rise and fall. In the early 1900s, there were over 2,000 car manufacturers in America. Today, only a handful remain. Many famous brands like Studebaker, Packard, Pontiac, and Oldsmobile are now just footnotes in history. Even the dominant players, General Motors, Ford, and Chrysler, have faced near-bankruptcy events, government bailouts, and decades of struggle. Buffett has observed that automakers are highly cyclical, meaning their success depends heavily on economic conditions. During economic downturns, car sales plummet, causing major financial problems. One of the biggest reasons Buffett dislikes the auto industry is that it requires massive amounts of capital to remain competitive. Unlike companies like Apple or Coca-Cola, which generate high profit margins with relatively low ongoing investment, automakers must constantly spend billions to develop new models. Every few years, companies must redesign their cars to stay relevant. Upgrade manufacturing plants. Car factories cost billions to build and maintain. Manage supply chains. Automakers rely on thousands of suppliers, making logistics complex. Compete on pricing. Car companies often cut prices to compete, reducing profit margins. Tesla, despite its innovation, is no exception. It continues to spend billions on gigafactories, battery technology, and global expansion. While this has fueled growth, it also makes the company vulnerable to economic downturns and shifting consumer demand. Instead of investing in car manufacturers, Buffett prefers to invest in companies that support industries rather than directly compete in them. For example, instead of investing in airlines, he invested in aircraft leasing companies. Instead of buying gold mines, he invested in companies that sell mining equipment. If Buffett were to invest in the electric vehicle revolution, he'd likely look at companies that supply batteries, charging infrastructure, or essential materials rather than a single automaker like Tesla, despite Buffett's skepticism. Many argue that Tesla is different from traditional automakers. Tesla has a tech-like approach to vehicles, integrating software, AI, and energy solutions. Brand loyalty, similar to companies like Apple, which keeps customers coming back. A lead in EV production and battery technology. But for Buffett, these advantages still don't outweigh the risks of the auto industry. In the next part, we'll discuss another key reason Buffett avoids Tesla: its reliance on hype and speculation, something Buffett has always warned against. Warren Buffett has spent his career warning investors about the dangers of hype and speculation. He believes that stocks should be valued based on business fundamentals, not excitement or market trends. Tesla, however, has often been one of the most hyped and speculative stocks in history. From its meteoric rise in share price to the passionate following of Elon Musk, Tesla represents a stock that Buffett would typically avoid. One of the biggest red flags for Buffett is Tesla's stock volatility. Unlike companies with stable earnings and predictable growth, Tesla's stock price has experienced massive swings, often driven by sentiment rather than fundamentals. Consider these events. In 2020, Tesla's stock price soared over 700% in a single year, making it one of the best-performing stocks in the world. In 2021, Tesla briefly surpassed a $1 trillion market cap, making it more valuable than nearly every other automaker combined. In 2022, Tesla's stock lost over 60% of its value, driven by concerns over Musk's focus on Twitter, interest rate hikes, and demand concerns. Buffett doesn't like stocks that behave like roller coasters. He prefers companies that grow steadily over time, like Coca-Cola or Apple, rather than stocks that can lose half their value in months due to speculation or investor sentiment. Buffett has repeatedly warned against investing in companies where the stock price is driven by hype rather than business fundamentals. He famously said, "The stock market is a device for transferring money from the impatient to the patient." Tesla's stock has often been fueled by retail investor enthusiasm. Tesla has a cult-like following, with many fans buying the stock simply because they believe in Musk. Social media influence, tweets from Elon Musk, have caused Tesla's stock to rise and fall dramatically. Short squeezes and momentum trading. At times, Tesla's stock price has surged due to short sellers being forced to buy back shares, rather than because of fundamental improvements. Buffett would rather invest in a boring, predictable company that delivers steady returns over time than a stock that swings wildly based on sentiment. Another reason Buffett avoids Tesla is that the company's stock valuation doesn't always match its business reality. For years, Tesla's valuation suggested that it would become the dominant automaker worldwide, even though it sold a fraction of the vehicles that companies like Toyota or Volkswagen produced. Buffett would likely argue that Tesla's valuation has often been too high for its actual earnings. And as a value investor, he would never buy a stock that is trading at an unreasonable price compared to its long-term earnings potential. Buffett's mentor, Benjamin Graham, taught him the principle of the margin of safety. The idea that investors should only buy a stock when it's trading below its intrinsic value, providing a cushion against losses. Tesla's stock has rarely provided a margin of safety. Instead, it has often been priced for perfection, meaning any misstep, whether in production, demand, or management decisions, could lead to a sharp decline in stock price. Buffett also prefers stable, disciplined leadership. While Elon Musk is undeniably brilliant, he is also unpredictable. Musk's behavior has included making controversial statements on Twitter that impact Tesla's stock price, focusing on multiple ventures, SpaceX, Neuralink, The Boring Company, and X/Twitter, instead of solely on Tesla, engaging in public disputes with regulators, investors, and even his own board members, Buffett likes CEOs who quietly build their businesses without unnecessary distractions. While Musk's approach has made Tesla a household name, it also introduces risk and volatility, two things Buffett dislikes. Another reason Buffett isn't interested in Tesla: it doesn't pay dividends. Buffett loves companies that return money to shareholders. He prefers businesses like Apple, which not only grow but also pay dividends and buy back shares. Tesla, on the other hand, reinvests all of its profits into growth and expansion, which doesn't align with Buffett's preference for mature, cash-generating businesses. Now that we've explored why Buffett avoids Tesla, its unpredictability, its industry risks, its speculative nature, and its volatile stock, we'll wrap up in the final part with Buffett's long-term approach to investing and why he believes in patience over chasing the next big thing. After analyzing all the reasons why Warren Buffett refuses to invest in Tesla, its unpredictable financials, high valuation, competitive risks, speculative stock behavior, and Elon Musk's leadership style, we come to the biggest reason of all: Buffett's long-term approach to investing. Buffett is famous for his buy and hold strategy. He doesn't invest in companies just because they are popular at the moment. Instead, he looks for businesses that will still be thriving 20, 30, or even 50 years from now. Take his biggest investments as examples. Coca-Cola (KO), he bought shares in the late 1980s and still holds them today, benefiting from its global brand and steady cash flow. Apple (APL), he started investing in Apple in 2016, recognizing its durable brand, strong ecosystem, and massive customer loyalty. American Express (AXB), another long-term holding, built on trust and financial reliability. Each of these companies has enduring value, predictable growth, and minimal disruption risks. Point: one of Buffett's biggest concerns with Tesla is whether it will maintain its dominance in the long run. The auto industry is historically unstable. Companies that were once leaders, like General Motors and Ford, have struggled over decades. Technology changes quickly. Just as Tesla disrupted traditional automakers, a new company could emerge and disrupt Tesla. Government regulations, energy shifts, and market demand fluctuate, making Tesla's future less predictable than the stable companies Buffett prefers. Buffett doesn't like uncertainty. He prefers businesses with proven long-term durability, something that Tesla, despite its success, hasn't yet fully demonstrated. Buffett often compares investing to baseball, but with a key difference: in investing, you don't have to swing at every pitch. Just because a company is popular doesn't mean you have to invest in it. Just because a stock is rising doesn't mean it's a good buy. Just because a company is innovative doesn't mean it's a guaranteed long-term winner. Buffett focuses on selecting only the best opportunities, those that offer long-term stability, predictable growth, and reasonable valuations. Tesla simply doesn't fit that mold for him. Ironically, had Buffett invested in Tesla early, he would have made tens of billions of dollars. Tesla's stock has been one of the best performing in history. But Buffett isn't driven by FOMO, fear of missing out. He knows that investing isn't about chasing the hottest stock, it's about finding companies that align with your principles and holding them for decades. For individual investors, Buffett's refusal to invest in Tesla teaches valuable lessons. Stick to what you understand. Don't invest in a company just because it's popular. Make sure you truly understand how it makes money. Avoid speculation. A stock driven by hype rather than fundamentals is risky. Think long-term. The best investments are those that will still be thriving decades from now. Be patient. You don't need to chase every hot stock to build wealth. Buffett's strategy has made him one of the richest people on earth, not by chasing trends, but by sticking to sound investing principles. Tesla may be an exciting company and it has made many investors wealthy. But for Buffett, it simply doesn't fit the mold of a company he's willing to bet on. And that is why Warren Buffett refuses to invest in Tesla.